Bear Stearns did not collapse because it lacked assets. It collapsed because it could not fund them. For years, short-term repo markets financed long-term mortgage positions. Confidence made that structure viable. Collateral reassured lenders. Leverage amplified returns. When subprime losses surfaced, haircuts increased. As haircuts increased, funding tightened. As funding tightened, liquidity disappeared. In March 2008, counterparties stopped rolling overnight financing. The firm was solvent on paper. It was illiquid in reality. Within days, an 85-year-old investment bank was sold under government pressure. The failure was not insolvency at first. It was funding fragility exposed by market distrust. Bear Stearns was founded in 1923 during a period when American capital markets were expanding rapidly. The firm developed a reputation for aggressive trading and strong client relationships within Wall Street. Over decades, it evolved from a brokerage partnership into a major global investment bank. Its headquarters in Manhattan symbolized its position within the financial district. By the early 2000s, Bear Stearns ranked among the largest securities firms in the United States. Its core activities included investment banking, securities trading, and prime brokerage services. The firm generated revenue primarily through trading operations rather than traditional corporate advisory work. Fixed income trading became one of its most profitable divisions. Within fixed income markets, the firm specialized heavily in mortgage-related securities. Mortgage bonds and structured credit products became central to its trading inventory. The firm developed expertise in packaging residential mortgages into securitized instruments. These securities were sold to institutional investors around the world. Bear Stearns also maintained large trading books that held these securities for market-making purposes. Market-making required the firm to maintain inventory to facilitate client transactions. This model generated consistent revenue during periods of stable credit markets. As housing finance expanded in the early 2000s, the firm increased its exposure to mortgage securities. Structured finance became one of the most profitable segments of the investment bank. Bear Stearns traders were deeply involved in creating and distributing mortgage-backed securities. The firm also sponsored hedge funds that invested heavily in structured mortgage products. These internal hedge funds were designed to profit from credit market opportunities. Mortgage securitization created large volumes of tradable financial assets. Investment banks like Bear Stearns earned fees from structuring these securities. They also earned trading profits from buying and selling them. The business model relied on continuous liquidity in global credit markets. Large inventories of securities required constant financing. Investment banks therefore relied on wholesale funding markets. These funding markets included repurchase agreements, commonly called repos. Repos allowed securities dealers to borrow cash against collateral overnight. This mechanism allowed large trading books to be financed cheaply. Short-term funding reduced financing costs and increased profitability. However, it also created dependency on market confidence. As long as lenders accepted the collateral, the system functioned smoothly. Bear Stearns operated within this structure for many years. Its risk management assumed that repo markets would remain liquid. Mortgage securities were considered reliable collateral during this period. Housing prices had risen consistently for several years. Default rates in mortgage pools appeared manageable. Credit ratings on many structured products remained high. Institutional investors trusted the stability of these instruments. This confidence allowed investment banks to expand their balance sheets. Bear Stearns therefore accumulated large positions in mortgage assets. The firm financed these assets primarily through short-term borrowing. Its profitability depended on the spread between asset yields and funding costs. In stable conditions, this model generated strong returns. However, the structure required continuous lender participation. If lenders withdrew funding, the trading inventory would become difficult to finance. This vulnerability was embedded within the structure of the business model. Bear Stearns remained profitable and respected prior to the credit market deterioration. Few observers questioned the sustainability of its funding structure during the expansion period. Structural takeaway: a trading model dependent on short-term financing creates hidden fragility when asset inventories are large. During the early 2000s, the U.S. housing market expanded rapidly. Mortgage lending volumes increased across both prime and subprime segments. Banks originated large numbers of residential mortgages for securitization. Investment banks purchased these loans and packaged them into securities. Mortgage-backed securities transformed individual home loans into tradable financial assets. Investors around the world purchased these securities to obtain steady yields. Bear Stearns became deeply involved in this securitization process. The firm structured mortgage-backed securities for institutional clients. It also held large quantities of these securities within its trading inventory. The trading desk treated mortgage bonds as liquid, marketable assets. These securities were commonly rated highly by credit rating agencies. High credit ratings increased investor confidence in mortgage products. Institutional portfolios across the world therefore accumulated mortgage-backed exposure. Bear Stearns expanded its mortgage trading operations to meet growing demand. The firm developed specialized teams focused on structured mortgage products. These teams engineered complex securities backed by pools of residential loans. Collateralized debt obligations were one such structure widely used during this period. These instruments divided mortgage risk into multiple tranches with different risk profiles. Senior tranches appeared relatively safe under prevailing housing assumptions. Lower tranches absorbed potential credit losses from mortgage defaults. This structure allowed large volumes of mortgage risk to be distributed to investors. Bear Stearns played a significant role in underwriting and distributing these products. The firm also traded these securities actively within secondary markets. Secondary market liquidity allowed traders to adjust positions frequently. This liquidity created the perception that mortgage securities were easy to sell. As demand increased, the supply of mortgage loans also expanded. Mortgage originators loosened underwriting standards in order to produce more loans. Subprime mortgages represented a growing portion of new loan issuance. These loans were extended to borrowers with weaker credit histories. Higher interest rates compensated investors for the additional credit risk. Structured finance techniques allowed these loans to be securitized despite their risk. Bear Stearns accumulated exposure through both trading inventory and structured deals. The firm's balance sheet gradually contained larger volumes of mortgage assets. Many of these assets depended on continued housing price stability. Rising housing values historically reduced default risk in mortgage portfolios. Market participants therefore assumed losses would remain manageable. Credit models often relied on historical housing market data. Those models assumed national housing price declines were unlikely. These assumptions influenced risk management across many investment banks. Bear Stearns was not unique in its mortgage exposure. However, its trading operations maintained particularly large mortgage inventories. These inventories generated trading profits during stable market conditions. However, they also concentrated exposure to housing market performance. Mortgage bonds therefore became a central component of the firm's balance sheet. When housing markets functioned normally, the model appeared sustainable. However, the structure relied on continued investor confidence in mortgage credit quality. If mortgage performance deteriorated, the market value of these securities could decline. Falling valuations would reduce the collateral value supporting short-term financing. Structural takeaway: concentrated exposure to securitized mortgage assets linked the firm's balance sheet directly to housing market stability. Investment banks typically finance large securities inventories through short-term borrowing. The primary mechanism used for this financing is the repurchase agreement market. A repo agreement is a short-term loan secured by financial collateral. In a repo transaction, a borrower sells securities temporarily in exchange for cash. The borrower simultaneously agrees to repurchase the same securities at a later date. The difference between the sale and repurchase price represents the interest cost. Repo agreements are usually very short-term in duration. Many transactions mature overnight and must be rolled continuously. This structure allows securities dealers to finance large portfolios efficiently. Investment banks therefore rely heavily on repo markets to fund trading inventories. Bear Stearns was deeply integrated into this repo financing structure. Large portions of its balance sheet were funded through overnight repo agreements. Mortgage-backed securities frequently served as collateral in these transactions. Lenders accepted these securities because they were considered high quality. High credit ratings reinforced lender confidence in the collateral. The repo market therefore became a critical funding channel for the firm. Each day, securities were pledged to obtain cash financing. The cash allowed the bank to maintain its trading positions. The following day, the repo agreements would mature and require renewal. Renewal depended on lenders continuing to accept the collateral. As long as lenders rolled the repos, the system remained stable. This process created continuous liquidity for securities dealers. However, the system required constant market confidence. If lenders refused to roll repos, the borrower would lose funding immediately. Unlike traditional bank deposits, repo financing is highly sensitive to risk perception. Lenders can withdraw funding simply by declining to renew transactions. This creates the potential for rapid liquidity stress. Bear Stearns financed tens of billions of dollars of securities through repos. A significant portion of these securities consisted of mortgage-related assets. The collateral value of these securities influenced lender willingness to finance them. If the collateral declined, lenders would demand larger safety margins. These safety margins are known as haircuts in repo markets. A haircut requires the borrower to post more collateral for the same amount of cash. Higher haircuts effectively reduce available financing capacity. If haircuts increase significantly, funding pressure can emerge quickly. Investment banks therefore monitor repo conditions closely. Stable repo markets are essential for securities dealer liquidity. During normal market conditions, repos appear routine and reliable. However, the stability of repo funding depends on lender confidence. Confidence itself depends on collateral quality and market conditions. If market participants doubt asset valuations, they may reduce lending. Such reductions can cascade through funding markets rapidly. Bear Stearns operated within this structure for many years without disruption. The firm assumed repo markets would remain continuously accessible. This assumption reflected the experience of long credit market stability. However, the reliance on overnight funding created structural vulnerability. A sudden withdrawal of repo financing would force rapid balance sheet adjustment. Such adjustment could require rapid asset sales under unfavorable conditions. Liquidity stress, therefore, can arise even when assets still exist. Structural takeaway: dependence on overnight repo financing makes institutional liquidity vulnerable to shifts in lender confidence. Leverage was a defining characteristic of large investment banks prior to the financial crisis. Leverage allows a firm to control large asset positions with relatively small amounts of equity. The strategy amplifies profits when asset values remain stable or rise. However, leverage also magnifies losses when asset values decline. Bear Stearns operated with a balance sheet that was highly leveraged relative to its equity capital. Like many investment banks, It used borrowed funds extensively to finance trading positions. This structure allowed the firm to expand its asset holdings significantly. In strong market conditions, leverage improved return on equity. Shareholders benefited from higher profitability during stable periods. Senior management, therefore, had incentives to maintain large trading inventories. Mortgage-backed securities provided attractive yields compared with Treasury securities. The yield difference encouraged banks to increase exposure to these assets. Bear Stearns accumulated large positions in mortgage-related instruments. These positions were financed largely through short-term borrowing. The leverage ratio of major investment banks increased throughout the early 2000s. Bear Stearns was among the firms operating with particularly high leverage levels. This meant that even small changes in asset values could affect the firm's capital position. High leverage also meant that lenders monitored collateral closely. The market value of securities, therefore, became critically important. If prices declined, lenders could demand additional collateral. This process could strain liquidity even without large credit losses. Bear Stearns risk managers monitored leverage metrics across the balance sheet. However, those metrics relied on assumptions about market liquidity. The assumption was that securities could be financed continuously. Mortgage bonds had historically traded with relatively low volatility. Risk models, therefore, assumed moderate fluctuations in asset values. Under those assumptions, leverage appeared manageable. The firm's capital structure reflected this confidence. Large asset portfolios were supported by comparatively thin equity layers. This structure was common across investment banks during the pre-crisis period. Competitive pressures encouraged firms to maintain similar leverage levels. Reducing leverage could reduce profitability relative to competitors. Management teams therefore balanced risk concerns with return expectations. Shareholder pressure reinforced this dynamic. As housing markets remained stable, leverage seemed sustainable. Balance sheets continued expanding as mortgage issuance grew. The perception of safety encouraged further balance sheet growth. However, leverage reduces margin for error during market stress. Even modest declines in asset prices can affect funding capacity. This occurs because collateral values determine borrowing limits. If prices fall, lenders become more cautious. They may demand additional margin or reduce lending exposure. This dynamic can quickly compress liquidity. Highly leveraged institutions, therefore, depend heavily on stable asset valuations. Bear Stearns entered 2007 with leverage that left limited tolerance for market disruption. The structure remained viable only while asset values retained market confidence. Structural takeaway: high leverage transforms moderate asset price declines into significant institutional liquidity pressure. By 2006, the U.S. housing market began showing signs of stress. Housing price growth slowed after several years of rapid expansion. Mortgage delinquencies started rising within certain borrower segments. Subprime mortgages experienced the earliest deterioration. Subprime loans were extended to borrowers with weaker credit histories. Many of these loans carried adjustable interest rates. When introductory rates reset, borrower payments increased. Higher payments placed pressure on household finances. As defaults increased, mortgage lenders faced growing losses. These losses began affecting securities backed by those loans. Mortgage-backed securities depended on the performance of underlying borrowers. If borrower defaults increased, investor returns declined. Credit markets therefore began reassessing mortgage risk. Prices of certain mortgage bonds started declining gradually. Structured credit products linked to subprime mortgages were particularly affected. Bear Stearns had significant exposure to mortgage-related securities. Two internal hedge funds sponsored by the firm were heavily invested in subprime instruments. These funds relied on borrowed financing to maintain positions. As mortgage markets weakened, the funds began experiencing losses. Declining collateral values triggered margin calls from lenders. Margin calls required the funds to post additional collateral. If collateral could not be provided, positions had to be liquidated. Liquidations placed additional selling pressure on mortgage securities. This downward pressure accelerated price declines. Bear Stearns attempted to stabilize the hedge funds during the summer of 2007. The firm injected financing in an effort to support the funds. However, market confidence in subprime assets was already weakening. Credit markets began questioning valuations across structured mortgage products. Pricing transparency in complex securities became limited. Few buyers were willing to purchase distressed mortgage bonds. This lack of buyers reduced market liquidity. Reduced liquidity caused wider price swings in structured credit markets. Risk models had not fully anticipated this level of illiquidity. Bear Stearns began facing increasing scrutiny from lenders and counterparties. Questions emerged regarding the valuation of mortgage assets. Analysts and investors examined the firm's balance sheet exposures. The collapse of the internal hedge funds intensified market concerns. Although the firm itself remained operational, confidence began eroding. Financial markets often react quickly to perceived uncertainty. Investment banks depend heavily on market confidence for funding access. As doubts spread, lenders become more cautious. Bear Stearns continued operating within a deteriorating mortgage environment. However, the stability of its funding model relied on asset credibility. When mortgage securities were questioned, the entire financing structure became vulnerable. The deterioration of subprime markets, therefore, had implications beyond credit losses. It affected the collateral foundation supporting repo financing. Structural takeaway: when collateral quality is questioned, the funding structure built upon it becomes unstable. Mortgage markets weakened, lenders began reassessing the risk of collateral. Repo lenders focus primarily on the quality and market value of pledged securities. If collateral appears uncertain, lenders protect themselves through higher haircuts. A haircut represents the percentage reduction applied to collateral value. Higher haircuts require borrowers to post more securities for the same amount of funding. During stable markets, haircuts on highly rated securities are usually very small. Mortgage-backed securities had historically received favorable haircut treatment. Lenders assumed these securities would remain liquid and reliable. As subprime losses became visible, this assumption began to weaken. Risk managers across financial institutions started reevaluating collateral valuations. Some lenders increased the margin required for mortgage-related collateral. These adjustments appeared modest at first. However, even small increases in haircuts can affect funding capacity. Bear Stearns relied heavily on repo funding secured by mortgage securities. Higher haircuts, therefore, required the firm to pledge additional collateral. This reduced the amount of securities available for trading operations. Liquidity pressure gradually increased within the firm's balance sheet. Funding desks had to locate additional collateral to maintain borrowing lines. Risk managers began monitoring liquidity buffers more closely. Lenders also shortened the maturity of repo agreements. Overnight financing became more common than multi-day financing. Shorter maturities increased the frequency of funding renewal. This meant lenders could reassess exposure each day. Daily reassessment made funding conditions more sensitive to market sentiment. If lenders became uncertain, they could simply decline to roll financing. This feature created an environment where confidence was crucial. Bear Stearns remained operational, but market perceptions were changing. Credit market participants were increasingly cautious about mortgage exposure. Some lenders began limiting the amount of mortgage collateral they would accept. Others demanded higher quality securities as collateral. These adjustments tightened the firm's available funding channels. Liquidity planning became more complex within the Treasury function. Treasury teams had to allocate collateral strategically across lenders. Competition for reliable funding sources increased across investment banks. The mortgage market deterioration was therefore influencing the funding market. Counterparty risk perception became a central concern. Institutions examined each other's balance sheet exposures closely. Bear Stearns continued to report significant asset holdings. However, lenders focused more on liquidity than asset totals. Asset values alone did not guarantee continued financing. The question lenders asked was whether collateral could be sold quickly if necessary. As mortgage securities became harder to value, lenders became cautious. Caution translated into stricter collateral requirements. These changes did not immediately stop funding flows. However, they gradually reduced the flexibility of the firm's balance sheet. Structural takeaway: rising repo haircuts transformed declining confidence into tightening institutional liquidity. By early 2008, the interaction between asset prices and funding conditions became increasingly visible. Mortgage securities were no longer viewed as uniformly reliable collateral. Market participants began demanding higher quality assets to secure short-term lending. This shift reduced the range of securities that could be easily financed. Bear Stearns still held substantial mortgage-related inventories. However, financing those inventories became more difficult. Liquidity pressure rarely appears as a single sudden event. Instead, it emerges through gradual reductions in available funding. Treasury desks monitor daily financing capacity to track these changes. At Bear Stearns, these daily indicators began tightening. Repo lenders requested additional collateral coverage for existing borrowing. The firm responded by reallocating securities across funding channels. Such reallocations temporarily maintained borrowing levels. However, the margin for operational flexibility was narrowing. Some counterparties shortened their lending horizons further. Financing that previously lasted several days shifted to overnight renewal. This increased the operational intensity of funding management. Each morning, Treasury teams needed to confirm the availability of financing. As counterparties reassessed exposure, uncertainty spread gradually. Bear Stearns continued conducting routine trading operations. Externally, the trading floor appeared orderly and functional. Internally, funding desks were managing increasing constraints. Collateral that had once financed multiple positions now financed fewer. The reduction in financing efficiency increased pressure on liquidity buffers. Liquidity buffers consist of cash and highly liquid securities. These buffers are designed to absorb temporary funding disruptions. However, buffers must remain sufficient relative to daily obligations. Bear Stearns monitored these reserves closely as conditions tightened. Mortgage market uncertainty continued influencing collateral valuations. Declining asset prices meant more collateral was needed for the same borrowing. This relationship gradually compressed available liquidity. Funding capacity is not determined solely by asset ownership. It depends on the ability to transform assets into cash through lenders. When that transformation becomes difficult, institutions experience liquidity compression. Bear Stearns still reported significant asset holdings during this period. However, lenders increasingly evaluated liquidity rather than total assets. Market participants began examining the firm's reliance on short-term financing. Analysts debated whether repo markets would remain stable. Uncertainty itself can alter market behavior. When institutions question funding stability, they adjust exposure cautiously. These adjustments can reinforce liquidity pressure. Bear Stearns' treasury operations worked continuously to maintain financing continuity. Despite those efforts, the available margin for adjustment kept shrinking. Liquidity stress, therefore, developed gradually rather than suddenly. By early March 2008, the firm's funding structure was under visible pressure. Structural takeaway: liquidity compression occurs when declining collateral confidence steadily restricts funding capacity. By March 2008, the liquidity pressure surrounding Bear Stearns intensified. Market participants increasingly questioned the firm's funding stability.
Rumors regarding the firm's liquidity circulated within financial markets. In wholesale funding markets, perception can influence behavior quickly. Repo lenders began reassessing their exposure to the firm. Some lenders reduced the size of transactions they were willing to roll. Others requested higher quality collateral for financing agreements. These changes reduced the firm's immediate funding capacity. Treasury teams attempted to maintain access to repo markets. Daily financing operations required careful coordination across counterparties. Even small reductions in lender participation created operational stress. Funding desks monitored intraday liquidity closely. Bear Stearns executives began engaging with regulators during this period. Senior management sought to reassure counterparties about the firm's financial position. Public statements emphasized the strength of the firm's asset base. However, funding markets were increasingly focused on liquidity rather than solvency. Liquidity confidence depends heavily on counterparty trust. If counterparties believe liquidity could deteriorate, they may reduce exposure. Such actions can accelerate liquidity pressure. By the second week of March, repo lenders were becoming more cautious. Some counterparties stopped rolling financing entirely. This forced the firm to locate alternative funding sources quickly. Treasury operations attempted to redistribute collateral to remaining lenders. However, the pool of willing lenders was shrinking. Financial markets were monitoring the situation closely. Investment banks operate within networks of interdependent counterparties. Concerns about one institution can spread rapidly through the system. Bear Stearns, therefore, entered a period of emergency negotiation. Executives contacted major financial institutions seeking financing support. The Federal Reserve began evaluating systemic implications. Regulators were concerned about potential contagion across financial markets. A disorderly collapse of a major investment bank could disrupt credit markets. Authorities, therefore, explored mechanisms to stabilize the situation. Discussions involved both private sector institutions and government agencies. The objective was to prevent immediate disruption in financial markets. Liquidity facilities were considered as temporary support mechanisms. Bear Stearns continued attempting to maintain trading operations. However, the firm's funding capacity was deteriorating rapidly. Confidence within the repo market was weakening. Financial institutions became increasingly cautious in extending credit. By mid-March, the firm's ability to finance daily operations was under severe pressure. The situation required a rapid resolution. Emergency discussions intensified over the course of several days. The outcome would determine whether the firm could survive independently. Structural takeaway. When counterparties simultaneously question liquidity stability, the funding structure of an institution can deteriorate rapidly. By mid-March 2008, Bear Stearns faced a severe liquidity crisis. The firm's ability to obtain short-term financing had deteriorated rapidly. Repo counterparties were increasingly unwilling to extend credit. Without daily financing, the firm could not maintain its trading inventory. Liquidity stress does not require immediate insolvency. Even institutions with large asset holdings can fail if funding disappears. Bear Stearns still reported substantial assets on its balance sheet. However, the firm lacked sufficient cash to sustain operations independently. Executives, therefore, intensified negotiations with regulators and potential acquirers. The Federal Reserve became directly involved in the situation. Authorities feared that an uncontrolled collapse could destabilize financial markets. Bear Stearns was deeply interconnected with other financial institutions. Counterparty exposure across derivatives and repo markets was significant. A sudden bankruptcy could disrupt payment and settlement systems. Regulators, therefore, explored options to facilitate a private sector solution. Attention turned toward JPMorgan Chase as a potential acquirer.
JPMorgan had the balance sheet capacity to absorb the firm. However, the acquisition required government support to manage risk. The Federal Reserve agreed to provide financing assistance. This support was structured through a special lending facility. The facility would finance a portfolio of Bear Stearns assets. This arrangement reduced the risk exposure for the acquiring institution. Negotiations progressed rapidly over the course of the weekend. Financial markets were scheduled to open again on Monday morning. Authorities wanted a resolution before trading resumed. On March 16, 2008, an agreement was announced. JPMorgan Chase would acquire Bear Stearns. The initial purchase price was set at $2 per share. This represented a dramatic decline from prior market valuations. Bear Stearns shares had traded above $100 a year earlier. The collapse, therefore, reflected an extraordinary destruction of shareholder value. The transaction was designed primarily to stabilize financial markets. Maintaining continuity of operations was considered essential. The acquisition ensured that Bear Stearns' trading obligations would continue. Clients and counterparties would not face immediate disruption. The Federal Reserve supported the transaction with asset financing guarantees. These guarantees allowed JPMorgan to assume the firm's operations. Later, the acquisition price was revised to $10 per share. This adjustment occurred after discussions with shareholders. Nevertheless, the outcome confirmed the firm's collapse as an independent institution. The acquisition marked one of the earliest major failures of the financial crisis. Bear Stearns ceased to exist as a standalone investment bank. The firm's operations were integrated into JPMorgan's broader structure. The resolution demonstrated how quickly liquidity crises can force institutional change. Structural takeaway: when liquidity collapses faster than solutions emerge, institutional survival may require external acquisition.
The collapse of Bear Stearns prompted immediate reassessment among regulators. Authorities recognized that liquidity failures could threaten large financial institutions quickly. The event highlighted vulnerabilities within the investment banking funding model. Unlike commercial banks, investment banks lacked stable deposit funding. Instead, they relied heavily on wholesale short-term financing markets. The repo market had functioned as a substitute funding base. However, this funding structure depended entirely on market confidence. When confidence deteriorated, financing could disappear rapidly. Regulators began examining systemic risks within the repo market. The stability of collateral valuation became a key concern. Mortgage securities had been widely used as financing collateral. Their declining value exposed weaknesses in the system. Institutions holding similar assets could face comparable liquidity pressures. Regulators therefore expanded monitoring of financial institution liquidity. Attention focused on the leverage of large investment banks. High leverage increased sensitivity to market volatility. Liquidity buffers were also reassessed across the industry. Institutions were encouraged to maintain stronger cash reserves. Central banks began exploring mechanisms to support market liquidity. The Federal Reserve introduced facilities designed to stabilize funding markets. One such program allowed investment banks to borrow directly from the central bank. This marked a significant shift in central bank policy. Historically, such access had been limited to commercial banks. Extending liquidity support to securities dealers reflected the severity of market stress. Authorities aimed to prevent a chain reaction of institutional failures. The Bear Stearns episode served as an early warning signal. Financial markets were still in the early stages of the broader crisis. Regulators also reviewed the interconnectedness of financial institutions. Counterparty exposure across derivatives markets was examined carefully. Clearing and settlement mechanisms were evaluated for resilience. Stress testing frameworks began receiving greater regulatory attention. Institutions were asked to model extreme liquidity scenarios. Risk management practices were reviewed across the financial system.
The importance of funding diversification became more widely recognized. Reliance on a single funding channel was viewed as dangerous. Regulatory discussions increasingly focused on systemic liquidity risk. Global regulators began coordinating responses to financial instability. International banking standards were gradually revised after the crisis. Liquidity coverage ratios were later introduced to strengthen resilience. These reforms attempted to ensure that institutions held liquid assets. Liquid assets can be sold or financed during market stress. Bear Stearns therefore became an influential case study in regulatory reform. Its collapse demonstrated how liquidity pressure can escalate quickly. Financial regulation increasingly focused on funding structures rather than only capital levels. Structural takeaway: financial stability requires institutions to maintain resilient funding structures under conditions of market stress. The collapse of Bear Stearns illustrates the difference between solvency and liquidity. Solvency refers to the value of assets relative to liabilities. Liquidity refers to the ability to meet obligations when they are due. An institution may appear solvent while still lacking sufficient liquidity. Bear Stearns reported substantial assets during the early stages of its crisis. However, those assets required financing to remain operational. When financing disappeared, liquidity pressure emerged rapidly. This distinction is central to understanding financial institution stability. Wholesale funding markets are highly sensitive to confidence. Unlike deposits, they can disappear quickly during uncertainty. Investment banks, therefore, face structural liquidity risk. Large trading inventories require continuous funding support. If lenders lose confidence, borrowing capacity declines. Declining borrowing capacity forces institutions to seek alternative financing. If alternatives are unavailable, liquidity deteriorates rapidly. This dynamic explains the speed of the Bear Stearns collapse. The firm's business model was viable during stable market conditions. However, it depended on continuous access to repo funding. Mortgage securities had previously served as reliable collateral. When confidence in those securities weakened, lenders reassessed risk. Higher haircuts and reduced financing created funding pressure. The firm still possessed large quantities of financial assets. However, those assets could not easily be converted into immediate cash. Market liquidity determines whether assets can be sold quickly. During the crisis, market liquidity declined sharply. Limited buyers made price discovery difficult. Uncertain prices discouraged further lending against the assets. Funding markets, therefore, tightened further. This feedback loop accelerated liquidity stress. Bear Stearns became the first major investment bank to collapse during the crisis. Its failure foreshadowed later institutional failures. Other institutions faced similar funding vulnerabilities. Financial markets gradually recognized the systemic implications. Regulators introduced reforms to address these structural weaknesses. However, the fundamental dynamics of liquidity risk remain relevant. Funding structures must remain resilient under adverse conditions. Confidence cannot be assumed permanently within financial markets. When confidence declines, lenders act quickly to protect capital. These defensive actions can intensify liquidity pressure. Institutions must therefore maintain funding flexibility. Diversified funding sources reduce vulnerability to market shifts. Liquidity buffers provide temporary protection during stress. However, buffers must be large enough to absorb shocks. Bear Stearns demonstrated how rapidly liquidity can evaporate. Corporate collapse often results from structure encountering stress. Structural takeaway: liquidity is conditional, and when funding depends on confidence, institutional structures become fragile.